Hello, this is Dr. Mahmoud Al-Odeh, and today we're going to discuss chapter 4 in this video. So chapter 4 will be about present value analysis. And in this chapter, we will be learning about these goals and objectives. Once you finish this chapter, you will be able to understand the concept of present benefit, present cost, present worth, and net present value. The second objective for this chapter is using equations to perform present worth analysis for a single alternative. Third objectives. The third objective is about conduct present worth analysis for multiple alternatives. So this is something new that you will be introduced in this chapter, where in the previous chapters, we've been talking about only one alternative. Now we're moving into two alternatives, how we could do the economics analysis using present worth in this chapter to select the best alternative. So we will be I will be showing you how you can do the present worth analysis for multiple alternatives. And these multiple alternatives could be an equal lifetime. They have a same equal life. So machine 1, machine 2, they both have, for example, 5 years of useful lifetime, or could be an alternative with infinite lifetime. And when we talk about infinite lifetime alternatives, that would be the government projects, like look into like building bridges, hospitals, pipelines, parks, these kind of things, that when we talk about the alternative with infinite lifetime. So we will be learning about all these things, whether conducting the present worth analysis for one alternative, two alternatives, whether they have a equal lifetime or different lifetime, or maybe even unlimited lifetime, which is infinity lifetime. And of course, we're going to use Excel. That's the last objective for this chapter. We'll be showing you how to use Excel to conduct the cost analysis. Before we go and talk about all these techniques and analysis, we need to take a look into some of the concepts that you will be using in this chapter. The first concept here, as you see in my slide, is the benefits. The benefit is these are the positive cash flow that coming into your project. These can be gained from a project or alternative. Cost, these are the expenses, the money that you pay, the negative cash flow that you pay to run a project or to adopt an alternative. The present worth, or the net present worth. So we have two terminologies for this, whether PW or NPV or PV. There are multiple terminologies and concept that we use, but that means the net present value, and that would be the profits or losses, basically, that can be occurred during a lifetime of a project or alternative. And these can be calculated by subtracting the present worth of benefit minus the present worth of cost. So in a short, to summarize it and make it simple for you, what is the net present value? You look into the benefit, subtract the benefits from the cost, and that whatever net the net cash flow, that would be the net present value. Again, it's just a simple equation, just to simplify it, of course, here. It could be just the benefit minus the cost, and find out if you're making money or losing money for that particular year. And then you consider the time value of money using the PV or NPV function, or one of the equations that we've learned in chapter 2 and 3. A new concept that we haven't introduced you yet, that's called the salvage value. The salvage value, it is the estimated value for an alternative or project assets or machine at the end of its useful life. So for example, if you have a machine, you use it for 10 years and now it's time to replace it, whatever the value for that machine to replace it, that's called a salvage value. So if you want to sell it to another, company who could, rebuild it and fix it and so on, that's what it's called, the salvage value. And again, this is a positive cash flow because you're generating money, there's a money coming into your pocket, so it is considered as a benefit. The cost is a negative cash flow, the benefit is a positive. The initial cost is a negative, of course, as you know, this is something that you have to pay out of your pocket, so this should be considered as a negative cash flow. Now, if we're dealing with one alternative, here's the first one. We're going to deal with one alternative. We're going to deal with five things. Look into the initial cost of the alternative, the benefits, the, the positive cash flows that come in into each period, the cost and expenses paid in each period, the lifetime of the alternative, and the salvage value. These are the five things that we need to look and consider. So there are different ways for doing it. The first methodology that I want to share with you is using um, the equations P equal F times 1 plus I to the power of minus N to the negative N, or you could use the interest rate table and you use P over F, which means find the present value if the future value is given for I and N. And we have this annotation. Please review chapter 2 if you're not familiar with this annotation for the interest rate tables. So for the first method, what we need to do, we need to find out what would be the net present, the net benefit value. So we need to find out all the positive transaction and with considering the time value of money, and we need to consider all the cost transaction, the negative transaction, and as you see in the step here, we need to subtract the cost from the benefit, or the benefit from the cost. So one more time, what we do, we find all the benefits, convert all the benefits into a present value. You could use the PV function, you could use the NPV function, you could use the P over F parameter, or you could use the P equal F times 1 plus I to the power of negative N. Either way would be fine. And then once you find all the positive transaction, add them together. And then now we're moving into the cost transactions and find what would be the cost for that project or alternative, and then add them together. And in the last step, to calculate the net present value, you subtract the benefit from, which is step 2, minus the cost, which is step 4. We will take an example in just a second, and I will show you how you could apply this. Another method for doing it, and this is my favorite way for doing it. It's simple and easy, but it's risky because in order to build, so this method is about cash flow, building a cash flow table. But before you build cash flow, you need to understand exactly what transaction do you have. So if you don't know how to build your cash flow table, then you're going to get a wrong result. And based on the wrong result, you will make a wrong decision. So what I want you to do is be careful and be familiar on how to build the cash flow table. And we did discuss that in previous chapters. So please review that chapter as well if you're not familiar on how to build the cash flow. But I will show you an example in just a second as well to remind you how to build the cash flow table. So the method 2, basically, you build the cash flow table considering the positive and the negative transaction for each year, and then eventually you use only one function, NPV, and then you get the net present value for that project. What we're going to do now, as I mentioned, we're going to apply this in example 1, and we're going to spend much time on example 1 to show you how we could apply the 3 methods for this example. So in example 1, the School of Technology, Art and Design would like to buy a CNC machine for $9,000. It is expected that this machine will generate a profit of $450 per year by doing projects for local community. If the cost for maintaining the machine is $150 per year, and the machine will last for 5 years before it is sold for $7,500. Calculate the present worth for this machine if I equal to 10%. So the first thing that I want to do, I'm going to go ahead and start with the first one, the second methodology, which is building the cash flow. I'm going to start with the easy technique before we go into the difficult one. So I'm going to share with you my Excel sheet here. All right, on the Excel sheet, what you see here, we have the, all right, just a second. Let's try one more time. Okay, here we go. Not this one, actually. All right, this is the one that I want to share with you. Okay, so for this example number 1, as you see, this School of to College Art and Design, would like to buy a machine, a CNC machine. And what I did, I built a cash flow for 5 years, 0, 1, 2, 3. So the cash flow table will look like this. The first column is for the years. The second column is for the net cash flow. And in that column, the net cash flow, we registered the net transaction. What is the net cash after we subtract the cost or the benefit from the cost? So on year 0, what we have, this is the starting year. We purchased the machine. That would be a $9,000. This is where we purchased the machine for $9,000. And as you see, this is a negative $9,000. And now we're going to year 1 all the way to year 5. What is happening on year 1? It's what is happening on year 1. We have a positive transaction, 450. These are just a profit from projects to local community. And we have a yearly maintenance and operational cost, 450. So what we have, the net cash flow for year 1 is $300. And the same thing we do for year 1 all the way to year 5. However, for year 5, we have a salvage value. We're going to sell the machine for 75. So it's a positive 7,500. We add it to year 5. And now we have a cash flow clean. And what we do is we use the NPV function. Now type equal NPV 10%. That's the rate. And then we select the values from the cells G7 all the way to G11, as you see, and add to that the G6, which is the initial cost. A common mistake that my students do every time is they consider all the cash flow from year 0 to 5. And this is wrong because year 0, it's in a present format. So you don't include it in the NPV function. And therefore, what you do is add it manually outside the function. All right, once you build your cash flow table, you use the NPV function and you will get this number, which is 3,205. Of course, it's a negative. As you see, this is a negative in red in parentheses, which means this project is losing. They're not making money from this machine. So from a financial perspective, this project is not economically justified. However, maybe we could justify it from learning and education purposes that yes, we could buy this machine so we could so our students could benefit from it. But if we look only for the financial perspective, no, this is not economically justified. And the reason for that, because the NPV, it's a negative. So once we see the negative NPV means that we don't make money out of that machine or project or alternative. Another way now, so this is for method 2 that we started. That's the easiest way to build your cash flow and do the NPV function. Another way for doing it is using the method 1, which is separating the positive cash flow from the negative cash flow. We're differentiating, we're separating the benefits from the costs. And we start year by year. So we have listed all the transaction, the positive transaction here. So as you see, this is my table. I'm going to highlight it here. And I will show you the cash flow, the positive cash flow. So if you look into the cash flow, we have a 400, positive 400 in year 1, all the way to year 4. On year 5, we add the 400. In additional to that would be the salvage value of 7,500. Another common mistake that my students do is they forget about the salvage value, in which that's going to give them a result number. So make sure to include the salvage value. And for the negative transaction, what we did, very similar to what we did for the positive transaction, the benefits, we calculated, we wrote down on the negative, the cost for this machine, and we have a $9,000 cost. You don't have to put the negative here because we already know this is a cost. So we're dealing with it as a cost, a separate table here. So we have a 9,000 in terms of cost, that's initial cost, and then 150 all the way from year 1 to 5. And with that, this is what you get for the cash flow, the cost cash flow table. And now what we need to do, we need to convert, because the question is asking you to convert it to a present worth. So what you need to do, use the PV function. So we use the PV function here for each transaction. So this is a PV function, and I'm going to show you something here. So PV 10% for this. So we are on year one, and we selected the 450. And what I want to do as well, I want to, instead of writing one, I'm going to select this cell here, which is M8, because I want to copy this function again for the rest of the cells, the next rows, and it will eliminate some time from me to type the number of years. So what we get here, 409, and as you see, this is a negative transaction, but we know that we're talking about benefit. What you need to do, you have to reverse the function by adding the negative sign here, and that would give you a positive 409, which is a benefit. What does that mean? The 450 a year from now would be equal to 409. And then we do the same thing. What we're going to do, we're going to copy the cell, just go to the right lower corner, select that corner and drag it all the way down. And that would give you what would be the equivalency for this transaction in a present format. And now we add all the positive transaction together. That would give you 6,362. That's what we call it, the net present value for the benefit, BPV, the benefit present value. And you could do the net present value as well if you need that. You use the NPV to be easier. You could all 10% NPV, 10%, and select all the cells from 1 to 5, and that would give you a positive 6,362. So, and we do the same thing for the negative cash flow. As you see here, we did listed all the negative cash flow, and we used the PV function in order to make sure that these are, we need to keep them as a positive because we know they already cost. So we don't want to confuse you by having a negative and saying cost. Yes, it is cost. Whether you add the negative to it, that's fine, or you make it as a positive number, but make sure that you have a title which says this is the cost. As you see here, once I've done the PV for each one of these years, I added them together to find what would be the cost present value, and that would be a 9,000. And now in order to find the net present value, we subtract the positive from the negative. So the NPV is equal to the result from this step here minus the cost cash flow, and that would give you 3,250. As you see, this is what we get from the previous method that we applied using the cash flow table. The third thing that I want to conclude this video is using the factors. So what I did here, I've listed all the factors for all these transactions. As you see, if we need to find what would be the equivalent of 450 in a present format, that would be P over F, find the present value if the future value is given with a I equal to 10%, and then this is year one. So I went back to the cash flow table. I'm gonna just show you that cash flow table in just a second, and I copied these values from the interest rate tables, and I multiplied the 450 by these values to find out what would be the present value for these transactions. So I'm going to share with you in just a second here interest rate tables. Interest rate table. So I've selected this through Oxford, and I went to the 10% interest rate. All right, here's 12, go back, here's the 10. So I'm going to zoom here. So what we have, we need to find the present if the future given for the years 1, 2, 3, 4, 5. So I used these numbers right here in this column, P over F column. So, and I copied them, I brought them to the Excel, and then once I have these values, I multiplied the number, the 400, for example, 450 times that factor from the interest rate table to give you 409, 371, etc. And then once you're done all this using the interest rate factors or the interest rate factors from the table, you add them together and you do the same thing for the cost transaction. And then once you're done, you subtract both from each other, the benefit minus the cost, and that would give you a net present value for that alternative. All right, so I'm going to stop right here. I hope this is helpful. I'm going to record another video for finding two alternatives, whether an equal lifetime or a different lifetime. And there will be another third video on the infinite lifetime project. So there will be 3 videos for this chapter. All right, so please let me know, review the video, and let me know if you have any question. I hope this is helpful.